The Disciplined Investor's Guide to Mr. Market. I want to spend some time today talking about one of the most important concepts in investing, a concept that can make the difference between building substantial wealth and watching your savings disappear. I want to introduce you to a fellow I do business with every single day. His name is Mr. Market. Now, Mr. Market. Market isn't a real person, but he might as well be. He's my hypothetical business partner in a small private company that we own together. Let's say it's a furniture store downtown. And let me tell you, this Mr. Market is quite a character. He's perhaps the most emotional business partner you could ever imagine, yet he's a wonderful teacher if you know how to handle him properly. You see, Mr. Market suffers from what you might call remarkable emotional instability. He swings wildly between incredible enthusiasm and utter despair, between unbounded optimism and the deepest pessimism you can imagine. Some days he wakes up feeling like he can conquer the world, and other days he can't even get out of bed for all the worries racing through his mind. Here's how our arrangement works. Every single day, without fail, regardless of the weather or what's happening in the world, Mr. Market shows up at your office and names a price at which he's willing to either buy your interest in the business from you or sell you his share of the business. Now, here's what's truly fascinating about this situation. The actual business that the two of you own together, that furniture store downtown, hasn't changed much from one day to the next. The value of that business depends on real, tangible things that don't fluctuate wildly with people's emotions. It depends on the quality of the furniture in the showroom, the skill of the craftsman in the workshop, the loyalty of its customer base, the amount of cash it generates each quarter, and the strength of its balance sheet. These fundamental factors simply don't change dramatically from Tuesday to Wednesday. But Mr. Market's prices, they change violently. They swing wildly based on whatever emotion has gripped him that particular morning. Some days he's so wildly optimistic, so blissfully euphoric about the future, that he names an incredibly high price for the business. Maybe he read a positive economic report over breakfast, or perhaps the sun is shining particularly brightly outside his window. Whatever the reason, on these days he sees nothing but blue skies ahead. He'll quote you a price that assumes the business will grow at an incredible rate forever, that competition will never emerge, and that everything will always go right. On other days, he's so depressed, so gripped by pessimism and fear, that he can only see terrible troubles on the horizon. Maybe he read a worrying headline in the newspaper, or perhaps it's raining outside and it's put him in a sour mood. On these dark days, he'll name a shockingly low price for your shared business. He'll act as if the roof is about to cave in, as if customers will never return, as if the entire enterprise is on the verge of collapse. Now, at this point, you have a crucial choice to make. You can let this emotionally unstable fellow be your guide. You can let his daily mood swings dictate your own feelings about the value of your shared enterprise. If he's euphoric and quotes a high price, you can feel wealthy and successful. If he's depressed and quotes a low price, you can feel poor and anxious about your investment. But I'm here to tell you that following Mr. Market's emotional lead would be one of the most tremendous mistakes you could make as an investor. It would be completely insane to base your assessment of your business's value on the emotional outbursts of this unstable partner. The intelligent investor, the disciplined investor, does something entirely different. They don't take instruction from Mr. Market. Instead, they learn to take advantage of him. When Mr. Market is in one of his manic states and offers you a ridiculously high price for your share of the business, a price that far exceeds any reasonable assessment of its true worth, you should be happy to sell to him. Thank him for his generosity, take his money, and wish him well. Conversely, when Mr. Market is in one of his depressive fits and offers you his share of the business at a pitifully low price, a price that represents a significant discount to what the business is actually worth, you should be happy to buy from him. Take advantage of his temporary misery to increase your ownership in a quality enterprise. And during all those other times, which is most of the time really, when Mr. Market's prices don't represent either extreme of emotion, you should simply ignore him completely. Go about your business, focus on the actual progress and fundamental performance of the company you own, and let this poor, emotionally troubled fellow rant and rave on your doorstep without giving his opinions a second thought. Now, You might be wondering what any of this has to do with you and your investments. Well, the entire stock market is nothing more than Mr. Market operating on a massive collective scale. Every single day, through the bid and ask prices of every publicly traded security, Mr. Market offers you a price for every company. He's just as emotional, just as unstable, and just as predictable in his unpredictability as he is in our little furniture store example. The foolish investor, and there are many of them, lets Mr. Dopper. Market's collective moods dictate their actions. They buy stocks when he's euphoric and everything is expensive, and they sell stocks when he's depressed and everything is cheap. They essentially do the exact opposite of what a rational business person would do. The disciplined investor, on the other hand, does the opposite. They understand Mr. Market's nature. They know the true value of the businesses they own or want to own, and they use Mr. Market's emotional instability to their distinct advantage. They're not swayed by his mood swings. They profit from them. So, the next time you turn on the financial news and see the market soaring to new heights with everyone around you giddy with excitement and talking about how this time it's different, remember what you're really seeing. That's just Mr. Market in one of his manic phases. Be cautious. Don't get swept up in his euphoria. This is when you should be thinking about selling, not buying. And the next time the market is plunging, when the headlines are full of doom and gloom, when your friends are panicking and selling their investments at any price, remember what's really happening. That's just Mr. Market in one of his depressive fits. Be greedy when others are fearful. See it as a magnificent sale on wonderful businesses. This is when you should be thinking about buying, not selling. Your job as an investor isn't to outsmart Mr. Market every single day. That's an impossible task that will only lead to frustration and poor returns. Your job is much simpler, though not necessarily easier. You must learn to outsmart yourself. You must resist the powerful primal urge to follow the herd. You must maintain your emotional discipline when everyone around you is losing theirs. If you can learn this one crucial lesson, to be greedy when Mr. Market is fearful, and fearful when Mr. Market is greedy, you will have learned one of the most valuable lessons in all of investing. You'll have positioned yourself to build substantial wealth over time, while the emotional investors who follow Mr. Market's every whim continue to buy high and sell low. This single insight, properly understood and consistently applied, can make all the difference in your financial future. It separates the true investors from the mere speculators. It's the foundation upon which lasting wealth is built.